Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. All right. Good morning, everybody. Welcome to PreMarket Prep. Spencer Israel, Joel Elconin, and Dennis Dick. I am here. I am in the office. My camera is not cooperating with me this week. I promise that that's the truth. I don't look battered or bruised or anything like that. I look normal. My camera is not working.
You look like you got hit by a brick wall.
Does it really?
Yeah.
Oh,
it does.
No, I didn't get hit by anything. I just, it was a long weekend, but I'm back. I'm glad to be back. I missed you guys. What did I miss anything interesting?
What's that movie where they got what's it, Bachelor Party or something?
Yeah, the Hangover. Yeah,
The Hangover. Yeah.
Yeah.
Mitch, can you put one of those guys over like with his teeth missing? Can you put that up?
No, none of that. Nothing like that. I swear, nothing like that.
All right, we missed you. This is a quick rundown
Share
of
your
the
chart,
future.
please.
Oh, share your
Yeah.
charts. Okay, I'm
Yeah.
already in the doghouse. So S&P futures only one key level coming in play this morning. We're down 6 1/4 at 45.7150. We have crude, nice rally in crude, up 70 cents at 103.98. What do you got over here? You got a trio of highs kind of sticking out to me. You have silver. That's in the green by 21 cents at 24.80. Skip gold down 320 in 1930.80. Bitcoin up 805 at 46,890. And Ethereum futures, they're up $35 at 35.41. Triple D, did you fall asleep on your keyboard last night?
Very much so. That was, like we keep saying, that was a slow night. That was a very, very slow night. There was nothing happening. VIX is now under 20.
Ugh.
FOMO's back in town. I mean, we're right back to playing the same song we played for feel like a year and a half or 2 years. We had a little bit of excitement there for a little while, but volatility coming down, FOMO going up.
So what does that mean? Does that mean that we're just going to continue to grind higher here? That all the worries, the war, inflation, recession, the housing market, everything
Well, it's lack of headlines, really. I mean, right now we're numb, and I've said this is shitty that, the market has become to this, but we're kind of numb to the headlines coming out of Ukraine. We know that they've done horrible things over there and the market's become numb to it. It's sickening that the market is numb to it, but it is. So, I mean, unless it escalates where we start seeing, obviously, using chemical weapons or nuclear, the market has accepted, what is happening over there, which is awful. So, I mean, and then you come and the market is kind of accepting of interest rates going up. Obviously they've priced in, we can see, the rates have been priced in to a certain extent here. So they've priced a lot in, so they're accepting of that. And they think inflation. So they think this Fed is going to navigate a soft landing. There are a separation, though, happening every single day. And I mean, I had to have a dozen people reaching out. I missed the bottom yesterday. Not joking, like a dozen people reaching out to me. Just should I buy? Should I buy? What should I do? What should I buy? The FOMO is just something rampant out there right now. And let's give a perspective here. I mean, it's not like everything is participating here. There's a lot of stocks not participating. It is value versus growth. And every single day it is Warren versus Kathy. And Kathy's stock's been getting a bid for a couple of weeks. Lo and behold, Berkshire, which could not go down, starting to sell off because they see Berkshire as safety trade. We don't want safety right now. We want aggressive, buying and beating down Momo names. So, I mean, that's what we're in right now. Like Citigroup, down every day. Value investing right now, not doing well in the last few weeks. Was doing very well for a while, but they're leaving those stocks out. So there's a separation happening here. It's not like everything is rallying with the SPY. We know SPY is just linked to Apple, Amazon, Google, which
Big
is
five.
Yeah, the big five. So they were doing their own thing too. So they kind of do their own thing. And then you have this value versus growth trade that continues to happen here. How this ends, obviously people think, the market's going to go up in the long term. So I think if I'm buying on these dips, eventually I'm going to make money. Probably true, but you got to pick the right stocks as well, because not all stocks continue to go up forever. We know that as well. So the way I've been approaching it, and I've been saying I'm approaching it, I'm very uncertain in this environment. So I have raised cash. Did I put some of that cash to work last week when I said? Yes. I brought myself up to 1.54% cash. I'm sitting around 40 right now. I put some more to work last week. That was a good thing, because some of these beaten down Momo names I was buying have started moving higher. But at the same time, would I like to be 100%? Would you love to be 100% invested on the up days and 100% short on the down days? Of course you would. But it's really hard to call that. So just find where you're comfortable. I can't tell you what to do. People are reaching out, should I buy? That depends on your own situation. If you're sitting with 100% cash, you probably should have been buying a while ago. 100% cash is a really lot of cash. That's betting on basically all of this really getting ugly. I was never that much cash. I got up to 50, and that is betting on it getting uglier as well. So have I been wrong? Absolutely. I've said that the last 3 weeks. I admitted it 2 weeks ago now, that you got to be buying some pullbacks here, because these stocks are just showing you too much bloody
Is there
resilience.
something in Canada where you could park that cash that you can get anything on it, or
Well,
is there?
well, one and a half. It's about the market. It's about moving in and moving out. And
No,
when
I'm
I
just
move money
asking.
in, when I see low risk, I move money out when I see risk. That is what I do. I am a risk manager. That is what I do. Did I miss the bottom? Absolutely. But again, what I was saying 4 or 5 days ago on the show, Spencer, we were saying this. We had consolidation. We were talking about ARKK. 5 days in the same spot. I'm like, if you want to take a shot, you can start actually buying these things now, because you've had the move, and now you've actually had some consolidation higher, or consolidation, and then the potential to move higher. And obviously we did. Yesterday we did that again, but we've really been chopping around. And have you missed the boat? I mean, let's give a perspective for people who are just like, oh my gosh, I missed the bottom. ARKK was $159. It's 70 today.
Yeah, you didn't miss
You're
nothing.
90 points off the high. So if you think, that if you're upset that you missed the first 15% of the move, maybe there's going to be more of a move. Nobody knows how this is going to happen, but I can tell you, people love it when I say, oh yeah, sell, and you were right, $110, $120, or $130 on ARC. And now they're calling me an idiot. It's at 70. We were bearish this bloody thing on 130. So, okay, so if you don't like it, buy your 70 back and scalp your 60 points. So that's how you could do it if you're really nervous about it.
Yeah,
I'm in
you
a
could.
little bit of stuff, a little
Yeah.
bit of Momo, but I'm still playing balanced portfolio. I have
Yeah.
no answers for you. Nobody has a crystal ball in this market. It's very difficult to predict what the next headline is going to be. So just look at your own portfolio, look at your own situation, look at your age, and figure out, what you want to do for yourself.
This is a great topic for our guest, Dennis, because he's the CIO at Comerica Bank, right? He has to deal with asset allocations
Yep.
for the big boys and everything, and it'll be good to get his perspective on this. So, you've been, very forthright, in what you're doing, and looking at, ARC right now. We can all see what it needs to do over the next couple days, for the rally to continue, and then similarly, we can all see on the downside, where, if it breaks a level, it's going to have some more downside. I will say, though, it's working on a monthly green candle, and we haven't been able to
It looks
see
healthy.
that. Yeah.
Again.
On a monthly, yeah, maybe if you get another couple days of consolidation here, it just seems like it's so fragile, you know, like it will have, will have these days, and actually you get a lot of green candles there, but it's just, it's not the arc of old. It's not going to rip like it did in 20 and up to that high in 21. It's a whole different market dynamic with it now. You have people that are just doing, first of all, you got people that are stuck, right? If this gets back to 80, I'm getting out.
Oh yeah.
Okay. Okay. And then you have people smarter, longer term, bigger investors that wrote, maybe were never in, started buying at 60, and, bigger funds that are, are just looking for just a reversal, some kind of you know, move back. What's the word I'm trying to think of? To the mean, mean reversion trade.
Yeah.
And so they're buying at 60, 59, 58, 57, whatever, and they're selling at 72. They don't care about it going back to 75. They don't care about it going back to 80. So it's a whole different market dynamic, and just gonna have to accept it. It's not the Ark of old, trading down 24 cents right now at 70.26.
But the sentiment, you can feel that it's turned towards this. Like, I don't know if it's going to stay turned. And is it cheap? And the nothing in the portfolio is cheap, but was it oversold? We've talked about being oversold for a long time. Could this have a rally to 100? It absolutely could. Is it going back to 160? I don't think so, not anytime soon, but it could go to 100. And it looks healthy. Like, you keep putting in these little, double bottoms. We just did it again. Joel, you patented the double bottom trick in your technical analysis, and it works.
Don't tell Edwards and McGee that.
It works so well. I mean, again, what happens? Little double bottom there 2 days ago. What do? We rip off of that. So, when I'm trading technicals, that's what I'm looking for, is those little setups, and obviously trading is one thing, investing is a whole different animal. It's tough to predict this market. The market's fairly easy to predict right now. It seems like day to day or hour to hour, not day to day, but in the next hour, you can kind of feel the turns. You can kind of see the momentum going. Oh, the 330 ramps coming, little stuff like that. And that's day trading. And that's why the day trading has been really good this year. The investing, a completely different animal. I mean, we're up, we're down, we're left, we're right, like chopping around. It's tricky. So, to say, the crystal ball thing, Dave say just bought a crystal ball in the chat. I mean, everybody wants to call the market. The truth is, to be a successful trader, you don't have to call the market. You don't have to do that. All you have to do is just trade your system, trade your technical levels, look for different setups, and stop yourself out when it's not working. Little setups, little double bottom, little double top. ARKK is the king of that. Yesterday, or let's go back. Look at this ARKK. It's crazy, the little double tops. March 29th, March 30th, little double top at 72, and it sells off. Then we go the next 2 days, go down 66, little double bottom 66, and it rallies. Those are nice little setups, nice little technical setups to lean on when you don't reach the previous day's
low. Has she been doing anything?
Nothing.
Her activity
is almost zil.
Is gone way down.
She doesn't have any dry powder.
I don't think that's not how it works.
Yeah, well, it is to a certain extent. There's creation redemption, so I mean,
okay. So as long as there are, but she can
reallocate.
Yeah,
she can do some different things. But she's choosing to do nothing.
Yeah,
she likes her setup. So, and you know what? I don't mind her setup right now either. I see a little double bottom in ARKK at $68 or $66, and I think, wow, a little pullback here today. Maybe do some nibbling. You stop yourself out under that. There's a case here, a bull case in ARK in the short term. In the long term, am I putting in my long-term portfolio? No, because I don't like her investment style. I don't like buying growth at any cost. But in the short term, is there trading in ARKK? Fantastic trading.
Yeah, Chris in the chat just said ARKK has been his best trading vehicle this year.
I trade every day.
Yeah.
I trade it every single day, multiple times. It's fantastic to trade. It's liquid as hell. It moves like nicely. It behaves. It behaves because it's an ETF. So you see, the major components going down. It's going to behave. It doesn't do its own animal-like tendencies. I love trading ARKK. I love the whole ARK group. I trade all those things. There's a couple of thinner ones like PRNT that I kind of avoid because they're just too thin. But ARKK, that's just awesome. In and out easily.
Wait, before we move on to the topics today, did anyone by chance, did you guys talk about the airlines yesterday? I was wondering if you were, because
we did, because of the delays.
I'm saying nobody reached out to see if I was going to be stuck in Vegas or not. I'm a little bit disappointed. What if I got trapped in Vegas?
Oh, that would be such a bad thing, Spencer. Trapped in Vegas.
Actually, Mitch mentioned the only people are going in and out of Vegas, so that's. But I didn't really think about that.
Half of my group got trapped. Are you kidding me? There was 12 of us there. 6 of us had our flights canceled. They had to drive to Los Angeles to take a new flight.
Really?
Yes. And we all wanted to get out of there. Nobody wanted to stay an extra day in Vegas. But anyway, okay. I just wanted to get that off my chest. Nobody reached out.
We did not. No, no
All
one
right,
reached out.
let's move
Our
on.
apologies.
From airlines to cruise lines.
Yeah.
This is interesting. Carnival Cruise Lines out with a PR yesterday that is very light on details, but here's the headline: Carnival Cruise Line sees its highest booking week ever as it finds another way to celebrate its 50th birthday. So the only detail in this press release is from the very first sentence, which says that last week was its busiest booking week in the company's history, showing a double-digit increase from the previous record 7-day booking total. That's all it says. There's no. I saw that headline and I thought, oh, maybe they're just saying it was a record week over week increase in terms of percent, but I don't know because there's really no details here. But that's not even the point, I guess, because the market just reads headlines anyway. So I guess lots of people are booking or rebooking their cruises last week. I don't know, but the stock is moving off of it.
They want an excuse to buy these stocks. I mean, people want an excuse to buy beaten down names. It is beaten down. It has rallied back in the last few weeks, but we know these algos only read the headlines anyways. It's a headline-driven market. Nobody reads the details. The human beings, maybe there's an analyst sitting there bored. Nobody's reading details. Even if you have details, nobody's reading the details. They say biggest booking cruise ever or whatever, and they're booba, yeah, let's buy it. And that's what the algos do. So it's not surprising off that headline that Carnival Cruise Line would be ripping here today. All the other ones are ripping as well. RCL, NCLH, CCL. They're all great to pair trade together. I pair trade these things all the time. CUK is your European version of CCL if you really want to get a little more exotic there with your trading, but CCL and CUK obviously move together with currency effects. Big pop.
Yeah. Now CCL was the one that came out with the news, right?
Yep.
Okay, so they're trading up the most, 20, they're trading at 2068. That's up 4.81%. RCL getting a nice move up more on a dollar basis, up 2.48, but 2.97%. And NCLH, that's trading in the green too, right in the middle. That's trading at 2276. That's up 0.79, or it's up 79 cents, 3.6%.
And then someone in the chat, I always forget that Disney does have cruise exposure for whatever reason. Disney's not really moving off this at all, but it's more diversified. But thanks for the reminder.
Disney hasn't been participating in this rally whatsoever. It tried a little bit yesterday afternoon. So it's interesting, and obviously this is a reopening trade. This is I don't know if you could call it. It's tough. Like I always kind of threw it in the value camp to a certain extent, but probably just because obviously the park's been closed and everything doesn't look like as much of a value story anymore. But it still is. Eventually, they're going to reinstate that dividend there too. I have a little bit of Disney in the long-term portfolio. I bought it too high. Kind of want to buy a little bit more, but I don't know. I'm just kind of comfy at 40% cash right now. Just feeling, I don't have the FOMO going. I can sleep well at night with 40% cash. If I was like all invested, I'd be like worried about the next Ukraine headline. So Disney is on my radar, but I just don't feel like buying stocks right now, like long term.
Stonks.
All right.
Stonks.
So cruise lines are moving off that. I want to also talk about coal here. Coal stocks like BTU, for example, are moving off of a report from the Wall Street Journal that the European Union is going to propose a ban on Russian coal imports. So BTU and ARCH are your big two movers, I think, thus far this morning.
Didn't Kenny come on our show like a month ago and give us BTU at like $16?
Mitch has been talking about BTU.
Mitch has been too. Yeah. Mitch and Kenny. This one just keeps going. It's getting a lift here again. I mean, trend is your friend. Got to get through the 2770 all-time highs. I don't like the candle yesterday that it got up there and then reversed and they pulled the rug out from under it. Now you get a lift here again. So that's the bogey. I wouldn't be buying at 2659 because I'm worried that the 2770 doesn't get taken out. So, but trend is your friend. The dip buyers yesterday rewarded immediately here. Buy stocks and uptrends, sell stocks and downtrends still seems to work.
Good, excellent recap on BTU there, and then what was the other one that you mentioned?
ARCH, Arch
Coal. So how's that doing? That's not trading up as much on a percentage basis. It's only up 659, almost 5%. 3,000 shares have traded, so up on pretty light volume.
Yeah, but as Dennis just said, coal's been hot here.
Oh, it's that
Yeah,
great trend.
yeah, it's been
Coal's hot.
It's
That's good.
definitely
I like that.
I mean, that's I mean, it's all the energy and raw materials trade all year, right? Oil
Yeah.
and coal and natty gas and all that stuff.
All that stuff has been overbought for so long, though, it looks tired. So that's one thing to consider, is that if we are going, and here's the argument: if you think the ARC is going back to 100, you're going to see these commodities get smacked. They're inversely correlated, ARC and the commodities. And you're seeing U.S. Steel still sitting up here near all-time highs. You're seeing Nucor, which I own, still up near all-time highs. You're seeing Cleveland Cliffs right up here near 52-week highs. So if you're really bullish ARC, you could just short commodities. I mean, there's an inverse correlation there.
Yeah, that's true. And Mitch just dropped us a few other tickers here for coal. We mentioned ARCH, but CEIX is another. I'm just going to drop tickers for you. I'll put them in the chat. CEIX is another one. METC, Mary Echo, Tango Charlie, ARLP, just a few. I just put all these in the YouTube chat. HCC as well. Just a few other coal names, just to have on your radar. Another headline I saw this morning out of GM. There seems to be a lot of like EV news today and yesterday. I know we had some deliveries, maybe on Friday / over the weekend. But this morning, GM with a headline: they are partnering with Honda to co-develop some EVs that will be in production, they say, in 2027. So 5 years from now. So that's exciting.
This market is so ridiculous because that headline broke. Like, when did that headline come out, Spencer? I just want to tell you how stupid this market is.
45.
743.
No, I think it was even earlier than that.
Yeah, maybe it's 740.
It broke a long time ago. I had it in front of me, and I can go try to see. It was a press release from GM. Came out at 7:32. 7:32. And it was kind of, no, it was even maybe before that. It was a while ago anyway. So it was a nothing burger. It wasn't really moving at all. And then CNBC breaking news at like 7:55 or 7:50, which is, their breaking news is always 20 minutes after everybody else. And they just start ripping. The algos see it off CNBC, breaking news, partnership, GM and Honda are going to make EVs. And they ripped General Motors all the way up 2%, over $44. And I'm like, this headline broke 20 minutes ago. Stock didn't even move on it. Now, because CNBC, you can just see the media influence, because they promoted this headline, and just rips higher. And I mean, are we learning anything new here? Is there anything new information here, Spencer? Really? That GM, I mean, do we think GM and Honda aren't going to make EVs?
Yeah,
is that what the market was
that's what I thought. I think the specific news is like they're working on co-developing, basically collaborating on the battery. That's the idea, right? They're gonna.
All right, so the collaboration is a new thing.
Yeah, the collaboration is new, specifically on the battery front. But yeah, it's not like we didn't know that GM and Honda and everybody, Toyota, Volkswagen, they're all making EVs, right?
They're all going EV.
Yeah.
In 10 years, EVs everywhere. Just
Yeah.
EVs.
Yeah.
Like, that's why I haven't been long-term bull raw oil. Wrong this year, but for that reason, is I do believe Kathy Wood is correct in that assessment, is that we're going electric. And there's going to be less demand for oil in the future, 5 to 10 years from now, but 5 to 10 years from now is not 5 to 10 days from now. So, I mean, obviously,
or 5 to 10 seconds if you're lifting the offers in GM, in Toyota or Honda,
or 20 minutes after the headline, which doesn't even move the stock, and then all of a sudden CNBC.
You're just mad you didn't buy it.
I know, kind of. I guess you just got to buy it, wait for the CNBC pop, and then
you
fade
forgot.
Dennis, I told you yesterday. EVs, baby. EVs. Look at the components: LiDAR, batteries. Look at the components behind EV.
Batteries may end up being like the differentiator here. There's actually another headline this morning. This one out of NEO, that they are in talks to license their battery technology to other automakers. I guess there's the potential here for the company that actually makes the best battery being the winner, right? The one that can make the most efficient battery, that can that can, acquire raw materials at a reasonable cost, and make the most efficient battery that they can then license to other automakers. Maybe there's the potential for that to be the key differentiator, because we're in this race now. There's a race to make EVs, but there's also a race to develop the best battery. And so the headline for NIO this morning suggests that they are at least further along than many of their peers. And that's what GM and Honda are really working on. It's the battery. So maybe the battery is where it's at here, but NIO is also up on that headline because the implication is the producer of the best battery wins.
Triple D, you getting hit on any bids out there? Are you getting hit on any bids? They coming after you a little bit here?
Was there news? Was it something?
There wasn't news, but it was just a 5-point whoosher. That's nothing. I just
oil popped a bit. I think
was it oil?
Yeah,
okay, I just saw it. I just don't
understand these relationships, and the day trading becomes so much easier. I mean, oil just popped, and then the S&P starts selling.
Okay, all right.
The inverse correlation between USO and SPY. Not even SPY. I guess it's not there the last week or two, but there's definitely a correlation there that the market wants lower oil prices.
I just didn't want you to get picked off there.
Thank you. But back to the timing of all this stuff. I mean, we can say, LiDAR, and we can say the batteries and stuff. Well, people were saying that, Mitch. People were saying that 2 years ago. They got their ass kicked. So why is now the time? And bring Mitch back on.
Hey, wait, hold on. I just saw this. Just came through. Twitter is appointing Elon to its board.
Well, that's a surprise.
Yeah.
Twitter.
Wow, what a shock.
Hold on.
I hope that cast covered is short.
We got the breaking news here. That was it. Sorry, I was delayed on that.
Did you? Oh, you talking about Dougie Cass?
Yeah, because he came on yesterday saying he's shorting at 49.50, and we said when it's down to 47, we're like, congratulations. But I was spooked. I was hoping to get down to 45 because I kind of wanted to go long it. Here we go. Continue. You did not fade Elon Musk on day one.
Well, here's the thing on the Dougie. He put a short rental.
That's what Doug does. We like Doug, so we're not going to.
Yeah, so I mean, a short rental.
On our show.
That means if it get 2 points on it, I'm covering it.
He's a day trader too.
Yeah.
Oh yeah, he is. Like Doug Cast trades. So, and you know what? And we gave him props yesterday. He said 49.5. The thing
went down.
47. I'm sure he covered it. I hope he covered it. He trades that stuff, and he doesn't stay on the short side that long.
This is so interesting. This is deja vu all over again here, because I wish I would have kept it on my charts. When was this? Right in this area. When did Jack leave? Do you remember that?
It was late November. It was the very end of November.
He's going to run this company.
Okay, this is when Jack. I'm talking. Jack. We were traded at 50 in the 49.50, and they announced Jack was leaving, and they took it up to 55. I remember it. I remember it as this, and then they absolutely crushed it that day, and ended up going down and never recovered. And now you're coming back to the point of no return here. Or return. We did do it. So that 55, that's actually where I sold a portion of my position, was that area. And boy, I'm tempted to get at the risk now, but whatever.
I would not want to be short this stock. Now
we say, why would you be short?
He's going to start talking. He tweeted about it last night. Do you want an edit button on Twitter? It's like he's almost running the company now. What do you guys want? Yeah. I mean, now he's on the board. You think they're not going to listen to Elon Musk? They're going to listen to every single thing he says and every single suggestion.
Even the CEO.
There's going to be no board member more influential. They're
going to kick everyone else off the board.
No, they're not.
But he's going to have say in this company, and people love that he's going to have say in this company. I love that he's going to have say in this company. I wanted to buy it yesterday I wanted to pull back to 45 to buy it. It didn't pull back enough, and now it's gone again. But I think the stock could see $60, man. I would not want to be short this stock.
What about DWAC on this, man?
This is DWAC.
Wow, another leg down here. DWAC.
What stock?
DWAC.
Yeah.
Oh,
Yeah.
yeah.
Well,
withdrawn.
that still hasn't even closed.
But you know how stupid this market is? Somebody was pointing it out last night. I'm not sure who it was on Twitter, so sorry I can't give you credit, but I saw it go by my Twitter timeline. At peak valuation, DWAC was worth more than Twitter. Did you know that?
Really? No,
Yeah,
I did
that's
not.
how stupid that this market can get at times. That's how stupid this market can get. It was worth more than Twitter at peak valuation. When it got up to $175 a share, DWAC had a higher market cap than Twitter.
Wow.
The thing that it's trying to come in and replace was all of a sudden worth more without even being anything. That's how crazy things get, man, with FOMO. And you know what? When it gets crazy like that, sell.
You know what's interesting about this is as part of this agreement of Elon joining Twitter's board, Elon is not allowed to own more than 14. This is in the 8K from this morning. Elon is not allowed to own more than 14.9% of the company while he's on the board.
They don't want to buy more.
They don't want to buy more. They're
like, this guy could buy the whole company. We know he could buy the whole company. If he wants to, he just buy the whole company on his personal account.
Yep. And Dennis, we kind of poo-pooed it yesterday, and we should have stuck with the theme. Did the other stocks moved off this? You see, with the move, Facebook had one of its best days in a long time. Also, Pins moved off it.
We didn't poo-poo it though. We just were surprised that that they weren't moving in the pre-market.
They weren't. Yeah,
but again, this is still company specific, so I wouldn't say all of a sudden, this is good news for all of them. That, is Elon coming and buying Pinterest now? Is Elon coming and buying Snapchat now? Is Elon coming and taking a position in Facebook? No. So there's sympathy trades, there's relationship-based trades that will pull those stocks up. But don't think because Twitter just rallied 50%, the Pins is the next one to go up 50%. I don't think that's the case. Very company specific here. I think this is very, very good news for Twitter. There's some headlines that are nothing burgers, and then there's headlines that are the biggest something burger you can chew on. And this is the biggest something burger you can chew on.
It's a triple something burger.
It's the triple something burger. It's the Big Mac with extra patty, the double Big Mac with all extra sauce. It's got everything. That's why it's hard to just, day one say, okay, 20% is too much for this, 29. Is it really though? When Elon Musk is going to start calling the shots in your company? I think that's a good thing. I'd like Elon Musk to call the shots on a lot of things, man. The guy is smart. Whether you think Tesla's overvalued or not, there's one thing you cannot argue with. This guy figures stuff out.
I don't know. He's a visionary when it comes to electric vehicles.
Space,
social media is a different.
Seems like social media is one
different business entirely. So
I'll just say he's an idea generator, and if he's sitting there on the board of Twitter, there'll be some ideas cooking there. Makes me want to own the stock.
You know what? I said this either at the end of last year or early this year. My hottest take for 2022 was that by the end of this year, Elon Musk will no longer be the CEO of Tesla. And this is another bow in my quiver for that argument.
Could you imagine?
He clearly wants to do other things. He clearly wants to do other things. This is another.
What would happen to Tesla stock if Elon Musk stepped down? How much does it fall?
He won't.
But again, we talked about that with Steve Jobs and Apple at one time, and it continued to go higher. But Musk is a whole nother animal here.
Yeah. All right. Let's bring on our guest today. Maybe he has opinions on all this. Who knows? John Lynch is the Chief Investment Officer at Comerica Wealth Management, joining us here for the first time on PreMarket Prep. Let's get him on the show right now. John Lynch, good morning. Thanks for joining us today.
Good morning, gentlemen. Good to see you all.
Do you have any opinions on what we were just talking about?
Yeah, fascinating. Can't speak specific stocks, but I will tell you, just been blown away by Elon Musk and his influence on technology, manufacturing, visionary. It's a treat to watch.
I mean, it's got, and obviously we don't have to talk about specific, but I mean, having Elon Musk on your board sounds like a pretty good thing to me, really. I mean, the guy's an idea generator.
Absolutely. And the point, I believe it was Dennis who made regarding they'd have to fire the rest of the board. I think he starts up right away as the as the primary voice, but nonetheless, they have a talented board. And, I do think, broadly speaking about, a lot of the stuff that, Elon Musk has done, not specific to Twitter, but I do think it's important for investors to recognize, certainly on the electronic vehicle, on the battery stuff, we've got copper, electronic vehicles require 4 times the amount of copper than a combustion engine. So for all the cleanliness, if you will, that people are counting on regarding the EV space, I think it's really important to appreciate the climate damage, if you will, that all that excess mining will do. So it's kind of a push-pull that I don't think investors truly appreciate.
All right, we're on with John Lynch, and he's the CIO of Comerica. And just to let you guys know how sharp this guy is, he worked for several years with Ryan Dietrich, and they came up over at LPL Financial. But let's we focus on a lot of the short term things that are going on in the market, but that's not your job. Your job is to focus on the long term here, and we're going to get to a couple tough questions for you. But your weekly market update was the curves within the curve here. Inflation versus recession, big debate. Just give us your long-term view on interest rates and where the Fed is. Are they going too slow? Are they going too fast, pushing us into recession? Where do you stand?
Thank you, Joel. And again, shout out to Ryan Dietrich, a dear friend who's an incredible analyst. And we used to refer to him as the stat king because he was so talented getting into the nitty gritty. And yes, I flew a little higher than Ryan on the analysis, looking more big picture, but it was a great partnership and he's still a great friend. Regarding the report we wrote this week, the curves within the curve, obviously there's been a lot of coverage on the inversion between the 2s and 10s. And the report we wrote yesterday, we thought that was kind of a false signal, a false flag, if you will, to use current parlance, because I do believe that the 10-year has received a safe haven bid really through the holiday holding period as a result of Omicron, and now as a result of the war in Ukraine. So I'm not convinced the 2s, 10s, the economic curve, as I like to call it, is really reflective of what's happening. We think the 90 days and 2s spread is more reflective of full employment, 7% inflation, and the global cyclical recovery. So the work we did showed that the time between inversion and recession, we identified 6 inversions since 1975. And, we found that a little more than a year before the economy slipped into recession. And then we saw over that time period, the S&P 500 was up north of 8%. So that analysis shows there's still time to participate for investors.
And what's the best way to participate here? We've had the decline. I mean, the other thing too is like we're so close to all-time highs here. I mean, for me, being a long-term investor, the way I look at things is 4,800. We're got 4,600 last week. I mean, where is it? I mean, are we finally going to see this major move out of value's been holding up for a long time into growth, or is that too early to make that call?
Yeah, I think the best way to participate is to stick with the cyclical value trade. You're going to get periodically, like yesterday, you're going to get periodically reflexive trades, I like to call it, for growth and passive. But I do believe with 7% inflation, this is a major regime shift. And I think investors need to appreciate what inflation actually means. And we're positioning portfolios to lean slightly toward value. I think you're going to see first quarter earnings come in about 5%, but I don't think anyone cares about the 5% print. I think everybody cares about what companies say about margins going forward. And we believe the value space, cyclical sectors like financials, industrials, materials, and continued strength in energy, we think those will continue to outperform this year. Going back to that analysis from yesterday's report, you typically see the value and cyclical sectors perform well for the 12 months following the first inversion. Once you start to get into recession, then and only then do you start to see, the utilities, consumer staples, and healthcare generate more sustainable returns. We've had 6 or 7 trading days of utility and staples outperformance, but I don't think that's a trend just yet. I think you're still going to see those companies that can have near-term earnings. You don't have that long duration that you see in growth. You have companies that can pay yield. You have companies that can buy back shares that can augment historically average or slightly better than historically average EPS growth.
John, when you say you are positioning portfolios tilted slightly towards value, you're as an asset allocator, how exactly do you go about doing that, and where is that money coming from or out of?
Sure. We positioned really last September, October, and we had been in growth. We let growth run for a while, perhaps too long at some points, but nonetheless, a rising rate environment. And I think this is important for all your investors to appreciate. Since QE, it's really been a very unique situation with low rates fueling valuations, particularly on the growth and on the passive style. In a higher inflationary environment where the Federal Reserve is raising interest rates, you are discounting future profit growth at a higher multiple, thereby decreasing the present and future value of that future earning stream. So consequently, we took the money from growth. Okay. We took some money from large, actually, and we're looking at more profitable small caps. When you have such low interest rates, the Russell 2000, for example, dramatically outperforming the S&P 600 for the better part of the past decade. Now you're starting to see companies in the S&P 600, IGR versus IWM, if you will, that maybe 10 or 15% of the S&P 600 doesn't have profits. Closer to 40% of the Russell 2000 doesn't have profits. And consequently, we really believe that in a rising rate, high inflationary environment, you're going to see a situation where investors are going to reward those companies who can deliver earnings, income, and share buybacks.
Now, everything depends on, where you're at in your investment horizon, and I'll talk to you about age differentiation here in a minute, but a question out of the chat for long-term investing, dollar cost averaging, or just being an index guy. I mean, that's certainly paved the way pretty well. I mean, it's underperformed in certain years, but and obviously you have a lot bigger investors. But what approach do you favor?
Well, no, we have individual investors as well, and we encourage investors not to buy near the high. Certainly, engage in a gradual, if you want to call it dollar cost averaging, or just a gradual entry process. If you want to do it a 6-month or a 12-month period, make sure you have a committed timeline for putting new cash to work. I do believe that, to your comment about indexing, Joel, in a low rate environment, I think that favored indexing and passive styles. But in a rising rate environment, I do believe you're going to start to see not all, but some active strategies outperform passive. It's going to be a major trend shift for the past decade or 12 years, quite frankly, 13 years, that investors need to become accustomed to.
And John, again, just in terms of how you go about allocating, it's in like broad funds?
Yes, yeah, we use an advice-driven model. So we use third-party asset managers. We screen, from a universe of a few thousand managers, and then from that screening process, we narrow it down relative to a variety of factors, and then earnings growth, performance, style adherence. There are a variety of factors from which we select.
Got it. And then we should just for a moment discuss the yield curve, and there's going to be some Fed speak today. We have a meeting in a couple of weeks ago. I guess a month or so now. What is your take on the yield curve right now, and even the curves within the curve?
Yeah, definitely. I think the policy curve is telling the better story. The 2-year Treasury has, I think, better reflected 7% inflation, full employment, and the cyclical recovery. And when the Fed made their pivot last fall, the 2-year went from 50 basis points to call it 240 or almost 250 this morning. So the 2-year has really accurately reflected and, quite frankly, priced in what the Fed intends to do. Obviously, the 90-day hasn't moved, nor has the Fed funds rate sufficiently to reflect that. But the 2-year Treasury has, and I think the 2-year Treasury has done a much better job selecting or depicting what the Fed is going to do in this, high inflationary environment. The 10-year again, subject to more safe haven bidding. And once we see the Fed, the Fed was buying bonds up until 3 weeks ago.
Yep.
So it's really a unique situation. I think you're going to see a gradual steepening of the curve. It's conceivable now we see a couple of 50 basis point hikes, but I think more important for the long end of the curve will be not having a $9 trillion balance sheet, stepping on the long end of the curve. And I think consequently, you're going to see gradual rate increases. So I think the economic curve, 2s to 10s, if you will, be more reflective of the current environment. And it may take 6 months before we get there as the Fed starts to buy fewer bonds, but they're still going to buy.
Yeah.
No, and just to be clear though, if we go out a little bit longer term, let's say go out 12 months, you're still bullish, correct?
Yes, yeah. I'm looking at a year-end 5,000 fair value on the S&P 500. I'm projecting 8 to 10% earnings growth. If we get 10%, that 5,000 sticks. After first quarter earnings, I'll get a better handle on what margins look like. It's conceivable I may have to take it down to 8%. It'll be really so much is dependent on the energy situation coming out of Europe, and no financial model is going to accurately depict that. So it really is going to come down to what the margin discussion is. But I still believe we still have cyclical tailwinds in the global economy. Companies have enormous operating leverage. I've been really impressed with what's happened over these past couple of years, whether wage costs, whether ability to absorb rising energy costs, and certainly all the interest expense that businesses have been able to refinance. That's all been able to see margins hover in that 12% range.
Yeah, the margin comment is interesting because I guess with inflation across the board, you don't know who theoretically the companies that are able to control their margins better are the ones that should survive better in an inflationary environment. But we'll have to find out, especially coming on the backs of we had another record quarter for buybacks. So
that's right.
I'd be very curious to see. We'll find out starting next weekish. 2 weeks.
That's right.
Exciting
time.
How all this plays out. This has been great, John Lynch.
I got one more for you.
Go ahead, Joel.
I want to throw one more in for you there. Just because we get we have a varying audience, varying ages, and way they invest in the market. Like, how do you talk to like someone that's young, like right now, with what's gone on in the market, over just the last few years? And decided, I'm not sure if you have children or how old they are. The meme environment, the value, the growth. I mean, what do you? And I'll just stick with that age. Maybe the next time we'll get you on, we'll have you address the other age groups. But what do you?
I'm glad you brought that up. We have 2 children. They're young adults. They're in their 20s. And when the whole meme thing came out, their significant others and the kids, we were all talking about it, and they made some pretty good trades over a short while. But I tried to encourage them not to be seduced by the fast buck. I think I preached the gospel of time in the market as opposed to timing the market.
Hey.
And I used it really as an instructive period to talk about the power of compounding. And I talked to them about investing in your 20s. Our good friend Ryan Dietrich has done a lot of work on what a total portfolio can be 30 years later if you invested at 22 or if you invested at 32, and investing right out of college and taking advantage of your company's 401k plans and putting a little away each month. That power of compounding is so important, and that's something we talk to our kids about, my wife and I, but more important when we talk to our investors and we talk to some of our younger investors, some of our younger customers at the bank, try to make sure everyone gets involved, at least something each month, so you're able to enjoy that power of compounding. Earnings and income may not get a lot of sexy headlines, but it can help investors achieve their long-term goals.
Could not agree more. Couldn't have said it better myself. John Lynch, CIO at Comerica. John, a pleasure to have you on.
Thank you, gentlemen. Have a great day.
Alrighty.
Thanks, John.
All right, it's 8:50 here. We got 10 minutes left in the show. Let's do some ticker time. Drop your questions into the chat. We will take a look at whatever you want to talk about. Also, whoever is posting in the YouTube chat in a language I don't understand, if you have a question, put it in English so I can understand what your question is. I don't know what you're saying, though, because I can't read that language. Okay. First ticker that I see is AT&T. So let's go there for Martin.
Martin has a fundamental question about the split. Like the official everything. He keeps asking about that.
Oh, like what's the date of the spinoff?
When the spinoff and stuff happens?
Yeah, I don't.
Well, he keeps asking about the merge, and I was looking, and I thought everything was complete. So
no, it's not.
Was there an official date?
I don't know.
The dividend's been adjusted though.
It's still 5%, and it goes
4.6. Yeah, yeah, but it's not 9. People are all saying, "Oh, it's 9. It's 9." The real dividend is there now. At least it's showing on my system as 4.6.
Right. Okay.
So the dividend, I believe that's been adjusted now.
It's going ex-dividend in a couple days, right? So it usually has a typical little bit run into.
I don't know. I didn't have it on my list yet.
The ex-dividend.
Good to know, though. Yeah, they typically do. AT&T and Verizon do run up in the ex-dividend day. What day did they go ex-dividend?
April 5th, I believe.
Well, that's today. So
no. Sorry.
So that's the record date.
I'm reading through a release here. The payable date is the 14th. What is the ex-dividend date here? I don't know. I don't know. Sorry.
I can research it. If you want.
The record date is April 14th. The payable date is May 3rd. So
yeah, it's the X date is what you want. So when you're doing dividend capture, the only date that matters is the ex-dividend date. That is the date you no longer receive it. So you got to buy it before the ex-dividend date, and the ex-dividend date, then they take a look, and whoever obviously owns it before the ex-dividend date gets paid. The ex-dividend date for AT&T is April the 13th. So it's coming up in 8 days. So does AT&T and Verizon show strength going into that ex-dividend? Yeah. Am I usually long ahead of those dates? Yeah, I am, just from a statistical arbitrage perspective. So I am not long AT&T yet, but will I get long and ahead of the date? Probably.
Did you see the pattern that Verizon put in a couple weeks ago? Obviously, we don't look at that stock. Did someone make a stand at 51 or what, Dennis? Have you seen that? That kind of reminds me of the old
big time.
Yeah, look it out. That's had
it's dividend, and what we say too, like when you're buying some of these stocks, is at a certain point in time, they're not cutting the dividend like they were in the AT&T case. I mean, there's people that say 5% is good enough, so that dividend gives you a little bit, not that it's a hard floor, but there's value investors, dividend investors that will come in at a certain price. When they start getting over 5%, which I'm assuming when it's getting down to 51, it's starting getting over 5, they're like, well, that's pretty good. So you can see every time it's got down near 51, it's been just a line in the sand. You can draw that line. Like, that's crazy, Joel.
I know.
That's a crazy line because it also coincides with the lows in January.
Yeah.
So,
I didn't even notice that.
Yeah.
There.
Yeah. So there is just somebody back. And when you see stuff like that, that's like institutional buyers, like people who are like
big time. Just say we're going to own all we can. Yeah.
We're just going to keep buying them. Yeah. You're selling, we're buying. And they're not letting it go down. And that's what we see happen. And obviously now it's starting to reverse off of that, but that's a hard support level.
All right, let's do some more stuff from the chat here. I'm seeing a few people mentioning Citigroup. They actually had a headline themselves. Citigroup is at least temporarily getting out of the SPAC underwriting game. They are they're pausing
sharp over there.
They are and it's notable because they're a prolific underwriter of SPACs. I saw that they had raised more than $31 billion I think they were the second largest SPAC underwriter in 2020, but they're pausing SPAC issuance just until they get more clarity from the SEC. But that has nothing to do with the stock today. I just wanted to throw that out there. How is Citigroup doing today? Oh, it's flat.
I just look at the TLT first. So you're trading banks. First thing you do is you look at the TLT. TLT is trading red. There is an inverse correlation. Again, it doesn't hold every single day, but it's there. And right now, relationships are a little screwed up because you got this value versus growth thing that's really taking everything. But the relationship is still fundamentally there. TLT goes lower, banks go higher. So you're seeing relative strength here today in some of the banks for the simple reason is that the TLT is weak here this morning.
New monthly low. I mean, you do have a pair of lows in the same area. That's, always a start of something. 51.77, 51.66 were the lows the last two sessions. You closed up $1 from there. You could probably find an intermediate level. 52.80 was the close. Maybe if you feel like you have to own it today, maybe throw a bit out a little bit lower. But the only thing I can give you is the pair of lows there. And $1 away from right now.
A few mentions of AMD. Looked at this one since it.
I'm long it. It's been not good so far. I mean, it's just this is why it just ticks you off investing in this market right now because I bought it like 113. It ran to 125, and you're like, oh, it's participating. And then all of a sudden, boom, boom. One headline, one downgrade. It was one downgrade.
Yeah, it was a big one.
10% off the price, which is just this market in a nutshell. It's like headline risk market, and now all of a sudden it's turned. And this was I stuck it in the long-term portfolio, so I'm trying not to like look at it, but you know me, I can't stop looking at it. So $109.80 AMD, down like 3 points on the purchase now after being up 12 points, which just pisses you off. You got a little double bottom in place, 106, 107. I just wanted some more exposure, and I wanted a stock that is the valuation cheap. No, but it's not crazy anymore. I think it's trading like 29, 30 times forward earnings.
Yeah,
it's not nuts.
Yeah,
it's not crazy. And I just think chips going forward. So it's a stock I wanted in my portfolio for a long time. We're $50 off the all-time high. Try not to look at it and hold your breath.
I just don't get like a warm fuzzy feeling from the monthly.
No, none of these though. What gives you a warm fuzzy feeling really besides Apple and the S&P? I mean, does Ark give you a warm fuzzy feeling?
Coal and oil.
Yeah. No.
At least it keeps you warm.
Yeah, exactly.
I mean, I think you could stay firm. Just $100. I mean, $100. Just stay there, bank on that being like a major bottom, like a decade bottom, and it's gonna bounce and go to 130 and then go back to all-time highs. I don't know, just like seems like it's just pressing. And if you have a big sell-off in the market and they take out 100, it's going to $80. I mean, that's the way you look at it. I couldn't step out here and say, I'm buying it at 110 and, where's my risk going to be? Your risk is down to 100.
All right. IBM. Wait, what was the question on IBM?
IBM.
Wait, hold on. There was a specific question. Is any opinions on it? Any opinion trading in the 129 to 131 range?
This just does nothing. This is big nothing burger. 5% dividend. It's almost like Verizon. I mean, the stock is just sitting there. It's on 20. Think about the volatility that we have endured in the last 6 months. And it's been really quiet. I mean, it's like Verizon now. It's a cash cow. People are in it for the dividend. I don't know. There's the growth. They've just never been able to figure it out. You keep thinking, they're going to figure it out eventually, but they never do. They just perennially disappoint. What is the all-time high in IBM? Like 200 and change, like 15 years ago?
206, perhaps?
When though? Like 8, 9, 10 years ago? 2013? Was it higher than that before that? Financial crisis? If you back up the truck a little bit further? No. I don't know. I'm just asking.
I remember. No.
That was it?
Yep.
You go back to 1999, it'll be high up there too. Go that far?
They cut me off at 20 years here.
Why did they cut you off at 20 years?
No. The 99 high was 132.
Okay. So we did 2012. So we've been a decade in IBM. If you bought it a decade ago, you're down $80. It's been an absolute disappointment. I guess you got paid a dividend, which is some consolation, but not much.
Kind of hanging. I mean, you can see where the support had formed last week, and then you could see or 2 weeks ago, and then you can see where the resistance formed last week, and now it's just smack dab in the middle there at 130.
All right. I promise for tomorrow I'll get my camera working so y'all can see my new face tattoo. But that's a wrap for our show today. Thanks to our guest, John Lynch. Thanks to all of you in our chat. Please remember all the information from our show is meant to be used as informational purposes only, not for investing or trading advice. And that is a wrap. Live trading starting up right now with Mitch Ryan Zunaid. Joel going over to PreMarketPrep.com for PreMarket Prep Plus. I'll catch you guys later. Everyone have a good rest of your day. Good luck at the open and make some money.